This question tests the effective use of standard costing and variance analysis as tools for managerial decision-making and performance improvement. Standard costs establish expected levels of cost, while variance analysis compares actual performance with standards to identify areas requiring management attention. The objective is not merely to calculate variances, but to improve future operations, planning, and cost control. The key phrase is better use of standard costs and variance analysis. Students should recognize that an effective standard costing system uses realistic standards, distinguishes between different types of costs, investigates both favorable and unfavorable variances when material, and updates standards when operating conditions change. Standards that become outdated or fail to reflect improvements in production technology can reduce the usefulness of variance analysis. Company A does not differentiate between variable and fixed overhead in calculating its overhead variances. Incorrect. Separating variable and fixed overhead variances provides more meaningful information about cost behavior and managerial performance. Combining them reduces the usefulness of variance analysis. B. Company B uses the prior year's average actual cost as the current year's standard. Incorrect. Standards should reflect expected efficient future performance, not simply last year's average actual costs, which may include inefficiencies and unusual events. C. Company C investigates only negative variances. Incorrect. Both unfavorable and favorable variances should be analyzed when significant. Favorable variances may reveal best practices that can be applied elsewhere, while some may result from poor quality materials or deferred maintenance. D. Company D constantly revises standards to reflect learning curves. Correct. As employees gain experience and production efficiency improves through learning curves, updating standards helps maintain realistic performance targets and provides more meaningful variance analysis for managerial decision-making. Correct answer. D. Company D constantly revises standards to reflect learning curves. Exam tip. An effective standard costing system should use current, realistic, and attainable standards. Regularly updating standards to reflect technological improvements and learning effects ensures that variances remain meaningful and useful for continuous performance improvement. This question tests understanding of labor standards and the consequences of setting standards that are too tight, too difficult to achieve. In standard costing systems, labor standards should be challenging yet attainable under efficient operating conditions. If standards are unrealistically strict, employees may become discouraged, unfavorable labor efficiency variances may occur frequently, incentive bonuses may rarely be earned, and production performance may fluctuate because workers become fatigued or demotivated. The key phrase is inconsistent with the consultant's conclusion. Since the consultant concluded that the labor standards are too tight, students must identify the statement that does not support that conclusion. In other words, 3 choices are consistent with unrealistic standards, while one suggests that the standards are likely to have been developed reasonably. A review of performance reports revealed the presence of many unfavorable efficiency variances. Incorrect. This is consistent with labor standards that are too tight. Employees regularly failing to meet standards would generate unfavorable labor efficiency variances. B. Michigan's budgeting process was well defined and based on a bottom-up philosophy. Correct. A bottom-up, participative budgeting process involves supervisors and employees in setting standards, making them more realistic and attainable. This fact is inconsistent with the conclusion that labor standards are excessively tight. C. Management noted that minimal incentive bonuses have been paid in recent periods. Incorrect. If standards are too difficult to achieve, employees are less likely to meet performance targets, resulting in few incentive bonuses, which supports the consultant's conclusion. D. Production supervisors found several significant fluctuations in manufacturing volume, with short-term increases in output being followed by rapid, sustained declines. Incorrect. Unrealistic standards may encourage temporary overexertion followed by fatigue and declining productivity, making this observation consistent with standards that are too tight. Correct answer. B. Michigan's budgeting process was well-defined and based on a bottom-up philosophy. Exam tip. Practical standards should be challenging but achievable. Participative or bottom-up approaches generally produce more realistic standards, while excessively tight standards often lead to unfavorable variances, low morale, reduced bonuses, and unstable productivity. This question tests the concept of budgetary slack, an important topic in management accounting and budgeting systems. Budgetary slack occurs when managers intentionally overestimate costs or underestimate revenues so that budget targets become easier to achieve. This behavior often arises when performance evaluations and bonus payments are tied directly to budget achievement, creating incentives for managers to manipulate budget estimates for personal benefit. The key phrase in the question is overestimating budgeted costs in order to obtain a higher bonus payment. This clearly indicates that the production manager is deliberately creating easier performance targets rather than preparing an objective and realistic budget. Such behavior reduces the effectiveness of the budgeting process, weakens resource allocation decisions, and may cause the organization to miss opportunities for cost reduction and operational improvement. Motivating employee effort. Incorrect. Although budgets can motivate employees, the manager's deliberate overestimation of costs is intended to make targets easier to achieve, not to increase employee effort or improve organizational performance. B. Building budgetary slack. Correct. Budgetary slack refers to the intentional inclusion of excess costs or understated revenues in a budget to make performance targets easier to attain. Managers may create slack to improve performance evaluations or increase bonus compensation. C. Balancing production costs. Incorrect. Balancing production costs refers to managing production expenses efficiently and has no connection with intentionally inflating budget estimates. D. Setting budgeted performance. Incorrect. Budgeted performance simply refers to establishing expected performance targets. It does not imply deliberate manipulation of budget assumptions for personal gain. Correct answer. B. Building budgetary slack. Exam tip. Remember the definition of budgetary slack. Overestimate expenses, underestimate revenues, create easier targets, increase the likelihood of favorable performance evaluations and bonuses. Budgetary slack reduces budget accuracy and can lead to inefficient decision-making and poor resource allocation.